Welcome to this week's episode of the Hidden Money Podcast. Today we are talking about the best tax strategies for high income earners. You're also our client base. The best strategy is give Revo a call. But if that's not the case, Kevin, how are we going with this?
You just teed up a lot. Where do I go? So if I had to put a list together and do, here's the best of what I would offer.
The ultimate tax strategy.
Step one, you sit down with a CPA, duh. So you've hopefully gotten that far. And hopefully they're bringing ideas to the table. I see so many times people are saying, I'm coming up with ideas and bringing them to my CPA. If that's the case, step one is your ultimate tax planning guide is to get a new CPA, because you should not be bringing ideas to them. You should be bringing facts to them, and they should be sending you the ideas. But
once in a while, it's okay. I've learned about some cool new things I never even knew was a business type venture. They told me, hey, I got an idea. Can I do anything with taxes? And then we dig into it. Like, man,
that's
this
true.
is a good idea.
I mean, yeah, it's not a blanket statement, but for the bulk of it, it's like, hey, I have a home office. Can I do that? Oh, yeah, you could do home office. I mean, come on. So,
so not all CPAs or tax preparers are created equal. There is a difference between tax planners or tax strategists and tax preparers. Most CPAs are tax preparers, and there's a need for that. And that's just how the profession's been for the last 100 years. But that needs to change. We're trying to change that paradigm here.
Yeah. So what we like to do, we offer different tax planning packages, but one of my favorite packages we offer is just creating a baseline scenario for somebody. And all that means is, let's say it's the year end, let's say it's October. We first have to diagnose where our issue is, because we can't solve for an issue without knowing what it is. Just like any doctor wouldn't just randomly throw a dart at a dartboard with medicine. They got to first diagnose what's the issue here and what do I prescribe. Same thing on the financial side, on the tax side. We have to know where your issues lie. So what we like to do is create a baseline scenario as if nothing changed, as if we get your pay stub, we get business financials, we pro forma the next couple months, and we say, if you do zero tax planning, here's what your tax return is likely to look like. We then take that baseline and diagnose 3 classifications of income from it. And this is kind of where the diagnosis comes from, is because you have 3 classifications you're typically working with. It's active, passive, or portfolio income.
We call these the buckets of income. The IRS requires you, and tax law requires you, to track your income and expenses in 3 separate buckets.
Yeah. So if we diagnose and you have a big capital gain event, you just sold some GameStop stock that went to the moon, that's capital gain. That's portfolio income. Your tax plan would look different from someone making the same $2 million in their business being self-employed. That's active income. So the 3 buckets, the active, passive, portfolio. Active income's your W-2. That's your self-employed income. That is earned income. That is active.
Or previously earned income, like pension plan.
Or pension plans, like, if you draw on your 401k, that was active at the time. It is now active. Even though you're not working anymore, that's active. Passive income, that is going to be real estate defaults to passive. Passive, I also like to just tell my clients, it's kind of like Shark Tank. It's like you pitch an idea, Cuban's going to hop on board as an equity owner, but he's not actively in your business. He is making a capital investment and might do some consulting, but he's not in the day-to-day business. He's hoping that he gets a dividend or a return on his investment. And if he does, that's passive to him, because he's not materially managing that business he bought into. So like a Shark Tank deal, if you're a passive partner receiving income, that's passive. So
I do think there are times. So I've gotten a great opportunity. I'm not going to name the guy, but who's actually been on the Shark Tank. He's got a great company that got started and funded on Shark Tank. And one of the guys on Shark Tank is his partner, funded him. And that guy's involved. So not always.
They're more
Shark
involved?
Not all the time.
Yeah, that's what I thought.
I understand some of the time. And at least in this case, those 2 guys hit it off, and that guy's involved. Another example, someone else on the Shark Tank, he has a team of private equity specialists, and the Shark Tank star is hardly ever involved. Maybe once or twice a year earnings call. So it'd be passive for them.
Yeah, straight passive. So, I mean, that's just a broad term, like, a Shark Tank deal. Just imagine yourself investing in something and hoping something comes back. And mailbox money.
Investor.
Yeah. So that's passive. And then portfolio income, that's your capital gains, interest, dividends. So step 1, we like to just create a baseline scenario, take that baseline, divide it into the buckets, then come alongside that baseline and provide tax planning strategies to help you in that specific classification.
Yeah, if you hadn't done the diagnosis and the analysis Kevin just said, you don't know where your tax opportunity or your tax problem lies. Is it an active problem? Is it a passive problem? Is it a portfolio problem?
Yep.
Then once you get that done.
Yeah, then when you get that done, you got to, so the reason, let's back up. A reason that's important is because if you have an active tax problem, you're a high W-2 earner, you can't go passively buy real estate. You can't go passively buy into a car wash business and be like, oh, I heard there's a lot of depreciation in car washes. I'm just going to go buy a car wash and all my management team will run it. I'll hire a manager that runs it or some director and I'm hands off and I get all that depreciation. That's passive. That's passive. Passive losses don't offset your active income. Now, there's always ways to move passive income to active classification, which is kind of why we diagnose first, is because if you have an active tax loss, active tax losses are the strongest losses in tax. They offset passive income, they offset portfolio income.
And active income.
Yeah, and active income. So if you have an active tax loss, and that's what we try to generate with our clients, is as much active tax loss as possible because it takes care of everything. If
that's where their high earnings are coming from, the active side. Occasionally we'll have people that have huge high passive income. We got to work on the passive income
or
strategy.
portfolio like gains, yeah. And so portfolio income, so from kind of like a even higher level, let's say you're a high W-2 earner, but you have some stock losses, capital gains, some of your stocks are losers. You can only deduct $3,000, and this has not been adjusted for inflation. It's been $3,000 since I've been aware.
Yeah.
So $3,000 of your capital loss is active. It can go against your active income. The rest carries forward.
If you lose $200,000
in a stock, yeah,
you get the ability to take a $3,000 deduction,
and then the rest carries forward. And so
that sucks.
That does suck.
But there's some ways around it sometimes.
Yeah,
if you're planning, if you're proactive about it.
Yeah. So you want to create that baseline with your CPA, just so you know what you're tackling, you know what you're up against. Break your income off into the 3 buckets. Then come alongside with analysis and scenarios and ideas and planning ideas. And that's what we do. We say, here's your baseline. Here are 5 tax strategies we can do that we could see make a major impact. And then you can pick which strategy you want because you're comparing them side by side. You can say, well, strategy 2 might cost you a $50,000 investment, but it might save you 30 in tax. And you can kind of see them all side by side. So that's kind of what we do with our clients is we take care of all the planning and ideas. Your job is to just have a meeting with us, sit down and provide us some documentation like financial statements or pay stubs. Charitable, we could take the same as last year. We can make it super easy and then come alongside with some ideas.
Yeah. But for the rest of this episode, the ultimate guide for high income earners, the majority of you are active income. That's where it is. So let's go through some pretty cool tax strategies. We're not going to give away the whole deal. There's so many out there. But we're going to get into a few of those. Where should we start, Kevin?
I would say where I would start is if you're self-employed, just maximizing all the deductions you have.
Big difference.
We go back to a future or a past podcast of ours for freelancers and contractors or side hustlers. We go through something like cell phone expense. Just make sure you're capturing the expenses that you're already incurring in your everyday life, like cell phone, your own computer, an iPad, a car, things you already have that you're using for business. Make sure we're capturing those expenses.
If you're using equipment, you got bonus depreciation. I mean, if you're self-employed, you have a lot more options. I mean, almost, I guess they're limited, but it seems unlimited to me options if you're self-employed or if you have a business and a high net worth earner. If you're W-2, we're going to get into some of those in a minute. But the other thing I want to say is one of the greatest ways, there's tons of ways to reduce your taxes. But the most beneficial way, in my opinion, if you're a high net worth or a high income earner each year, most likely the super majority of the American public, you are trading your time for money. Yeah, you're getting a lot more per hour, but you're ultimately an hourly employee, and there's only so much time in life. How long are you going to be able to do that? Do you want to keep doing it all the way through retirement? Do you have a family? Do you want to keep having to earn that money hour after hour and not be able to spend time with your wife and your kids, or your husband and your kids? No, I don't think you should. If you're a high net worth earner, you have opportunities now to use the tax code to make tax advantage investments to start growing your financial portfolio to where you have financial freedom. And it doesn't take 20 years. In a lot of cases, we see it takes 2 or 3 and boom, people are cutting back their hours.
Yeah. So I would definitely meet with a CPA. Let's look at alternative investments that can grow net worth and save on your taxes. Hopefully we're not just kind of like rapidly trying to tax plan in October. That's what Mike and I are preaching, please. Tax plan the whole year. This year's a little weird with tax law being up in the air in 2025, being June of 2025. It is a little weird that we don't have concrete tax law, but
We're getting closer.
yeah, we're getting closer, but the bulk of your tax plan can be done. Tax law from that standpoint is likely not going to change from this account of like real estate professional status. That stuff is not changing. What's going to change is the amount of impact that strategy would have. You can impact the strategy. It's just a matter of, are we going to have more impact or less impact comparative if this bill goes through?
But guaranteed to be impact.
Yes.
And understand when you're making a tax advantage investment, the IRS is in reality, they are subsidizing your investment. They're paying for a part of your investment. So you get more to put away because the IRS is lowering your taxes. That snowballs, man. You do that a few years after year, and suddenly instead of having whatever you would have invested without thinking tax strategy, 3 years from now, you might have 5 times more, or at least 2 times more than you would have had if you weren't doing it tax advantageous. Not every time, but it's powerful, man. Tax advantageous investments can help you build that financial freedom a lot faster.
Absolutely. So if you're self-employed, let's maximize our deductions in our business. We want to also look at our stocks. If you have crypto, I got a strategy for you. I'll give to you. So if let's say you own Apple stock, and you, at the end of the year, and I'm picking on Apple, whatever, but let's say it's December 30th, you look at your portfolio of Apple stock and it's down. You're down $30,000 from what you paid for it. You could sell it, get your money back, harvest your $30,000 loss, then January 1st, buy that stock back, right? You could do that. But that loss is not deductible. That's called a wash. So you can't play with that timing. You have to wait a specified number of days 60 days before you rebuy that same position or a position like it. So that's called a wash sale. If you're in crypto, there is no wash sales in crypto. So let's say you do have, now this is a portfolio move, so make sure this is tax strategy is even going to be worth it.
Don't let your tax tail wag your financial dog, your business dog, your investing dog.
Yeah, but this won't even wag it because you're going to essentially get in the same position, I think. So, but if you have other capital gains, you've harvested maybe from some stock sales. Let's say Apple killed it and you sold some and you have $100,000 of cap gain.
Yeah.
But you're a crypto bro, and you're holding on to all this. Really is the case with Bitcoin.
Not recently,
right now,
but it was the last couple of years before that.
So it could be, let's say you have actual legit capital gain from selling Apple. They did well, but you're holding crypto on the side, and it's December 30th. You could sell out of your crypto position and then rebuy into that crypto position in January 1st and essentially be right where you started, right?
And boom, you harvested that
capital loss. There's no wash sales in crypto. So just something that's a good year-end planning tip if you have capital gains and have crypto.
Yeah. I mean, we could get in so much more detail. We don't have enough time on this podcast. But there's so many other ways to handle things like that. There are mutual funds out there that grow in net value. There's so many ways you can handle that. That's why it's important to either get good at tax or find someone that is.
Yep. Another strategy I would say is, if it's October, November, and you're just doing your baseline and diagnosis, that's okay. There are passive ways to invest and get active loss treatment. And this is why Mike and I started our own oil fund last year.
Drill, baby, drill.
Yes, we started our own oil fund last year for this specific reason, because we have a lot of clients in this situation where they may not tax plan, or they come to us late in the year from another CPA and they're just like, what do I do? What do I do?
Or they just don't have any time to deal with something that requires active participation.
Yes. So if you invest into a working interest oil and gas operation,
understand this is very detailed. You gotta jump through the hoops, dot your I's, cross your T's. Working interest has a very legal meaning in the tax code. It's got to be a working interest. If you don't understand what it is, learn it before you just go invest.
Yes. So make sure that your team, we preach team, accountants, attorneys, financial advisors, get your team, if you're going to start kind of kicking the tires on these deals, get them the PPM, the private placement memorandum, give them the operating agreement of the investment you're looking at, access the subscription documents and all this. Get your team those documents because the CPA will be able to sniff these out pretty quick. The financial advisor could share some insight on the ROI or kind of, hey, this is over promoted, whatever.
Yeah, just recently I had a client come and say, hey man, I've heard you about oil and gas. I found a fund I want to do. Can I invest in it? Will it work? He told me on the phone all about it. It sounded like it might, but I said, send us the PPM. That the investment was in a limited liability company. So he was going to become a limited liability company member and thought he was going to get the working interest deduction against his active
You got to
income.
have general liability.
He didn't have liability because the LLC blocked it, right? You cannot have it in LLC. You got to have liability. Be careful with that because it's real general partner liability. But you get insurance for it. We do that in our fund.
Yeah. And so that's why we love oil and gas, is because you get to passively invest into these operations. Now, it's risky. We always say also to our clients, don't spend money you can't lose in this plan. But if you invest into a working interest oil and gas operation as a general partner, there's a lot of intangible drilling, what's called intangible drilling costs that come down to the partners. There is depreciation. There's other operating expenditures. To get these wells up and running is a lot of manual labor. It's a lot of expense, capital expenditures. And so you get your portion of all of that. And it's active. It's in the active classification. So if you did your diagnosis and you're a high W-2 earner or self-employed, you could passively invest into working interest oil and gas operations as a general partner and potentially write off 70. In our case, I think ours was like 78, 76%. 76% of your initial investment in the active tax bracket or active tax bucket as a loss.
And that's very likely to change this year. If we get 100% bonus depreciation back, you could see 90%. So you invest $100,000. If it's a 90%, you invest $100,000, you get a $90,000 deduction against your active income. If you're in the top tax bracket, that's going to give you over $34,000 of tax reduction. The IRS paid $35,000 for it. You really only net out of pocket $66,000. That's beautiful.
Yeah.
That's how you grow financial freedom, man.
And in oil and gas, and because this podcast is we're trying to aim at the high net worth individuals here. Oil and gas, even the income you receive in future years is only 85% taxed.
Yeah.
All the income you get going forward too.
I love that.
So you don't even get 100% taxation on the return on your investment.
You get
it's
a
85.
big deduction. Even if you get to deduct every dollar you've already invested, you get something called percentage depletion. And like Kevin said, you're only going to pay tax on 85% of the income. And that could be a lifetime, depending on what kind of investment you're making in.
Yeah, and oil and gas is risky. That's why our fund solves two problems. It solves the riskiness a little bit. It's still risky, but we've spread our investment out among different operators in one fund. Because to invest in these oil funds, you need a minimum of 50, 100, even 250 we've seen. Minimum investment to get into these oil and gas funds.
If you want to get in 4 funds, you've got to come up with 4 minimums. Now, if you got $1 million, that's fine. You're going to spend some more time finding these and doing due diligence.
So we did our best to do. We're not oil and gas, so we're not in the field. Mike, you visited some, but we are CPAs by trade. We know finances, we think, pretty well. But these are spaces that we're new in. We hired consultants. We had oil and gas consultants who's been in the industry for a long time to help us vet these. So, but in our fund, we have 4 operators, and we take let's say you only have 50,000. Well, you can't take your 50,000 and go to 4 operators.
Yeah.
Those minimums you got to hit. So that's what our fund solves. First solves the minimum issue is because I can take your 50, dice it up into four different, and then I can meet the minimums because we're pooling your money in with other investors. So we can hit the minimums and get you diversified. The second solution that we have in our oil fund is the actual GP liability risk being insured. Now we voted on in our first fund, we had a partner meeting with all of our investors or the ones that could make it. We did a poll, and the majority of them said we want insurance. And so what insurance does is it's a high premium. That's why we had to poll
ridiculously high.
Yeah. So we have general partner liability. That's what makes this investment go from a passive classification to the active classification is your risk. And that's what GP does, is it allows for risk. So if you're passive or in an LLC and you don't have that liability risk, oil and gas doesn't help you. So you get GP liability, but we insure our GP liability position. So if there is a claim on the general partners, which are very rare, after speaking to our multiple
Two
attorneys,
attorneys we hired to go find them. They can hardly find any cases.
they can't find
Still
many
keeps
cases.
me up at night.
Yeah,
Yeah.
but we are GPs in these things, but we have insurance to cover that. So we solve the diversification, the minimums, and we have insurance to cover our GP claims. And it doesn't affect your tax deduction. You get the full-blown IDC, depletion, all of that is still up for grabs. And we're just making this investment the best we can.
Yeah.
It's great.
Generally speaking, you don't have to invest in our fund. As a matter of fact, our fund's really just for our clients and close friends and stuff. But you can invest in this. Just make sure you're doing it right. You cannot, like Kevin said, you can't create an LLC to go buy your oil and gas investment and think you're going to get a deduction, get your active income. It's not allowed. Just follow the rules. Find someone who can teach you the rules if you don't know them. Follow them, and it's a great tax benefit. Give me one other big one. We've got a few minutes left here in this episode.
I'm not going to give the full secret away.
Okay.
Let's just blue sky this and just pretend. What if you could give $50,000 to a charity and get $250,000 tax deduction?
I mean, it depends if I like the charity and what my income's at. If I'm a high net worth earner, whatever I pay in that charity, I'm going to save back and then some in taxes. So it'd be nice. It'd be a last resort because you're not going to ever get an ROI on that except that immediate tax deduction and reduction. So I would do that at the end of the year.
So a 5X charity investment.
That sounds like a conservation easement. Remember, those are illegal. They don't roll.
And those are on the dirty dozen for the past, how many years? The IRS is on a
For
conference.
25 years, but they changed the law recently under our last president, and you can't get away with it. They were doing
Yeah,
so.
this is not a conservation easement. This is not dealing with land.
Okay.
So, but there's ways to structure charity giving to get you a multiple on your giving. So the thought being, I'm just going to give you a high level. Let's say you bought a couch. You spent $5,000 on this couch.
Yeah.
5 years from now, you want a new couch.
Let's say that couch, Joe Rogan comes and sits on that couch, gets pictures of that couch, and it's like a viral episode. Now someone's willing to pay $30,000 for that couch. What happens then?
Okay. So you have a couch that you bought for $5,000.
Mm-hmm.
Joe Rogan sits down, takes a picture, goes viral, and now all the people want Joe Rogan's
All the people that love
seat.
Joe Rogan.
Yeah, whatever. Weird, but okay.
That is weird, but
I'll go
it
with
could
it.
happen.
It could happen. Or it could happen.
Yeah.
That couch is now worth $30,000. You could donate that couch to a charity, get a valuation on that charity, and you get a deduction, a charity deduction, not on the cost. You paid $5,000. You get a deduction on the fair market value of that couch, which is $30,000. So you get a charitable write-off of $30,000 on a $5,000 couch.
That's awesome. Let me just kind of explain a little bit more. What you're probably more familiar with, and this is very common, if you have a security, let's say you bought Apple in 2000, you put whatever, and it's gone up 50x, or I think it would go about 30, 40x. Say you did that. You put in 10,000, it's now worth a lot more, $500,000. If you sell that stock, you're going to pay capital gains. And then you could go ahead and pay the tax and whatever's left over, give it to the charity. Or if you wanted to give it to charity, you could give the stock to the charity without selling it. You get the current fair value as a deduction, even though you paid a lot less for it. You don't recognize income. The charity takes it, they go sell it, they appreciate it, helps the charity out. You got a deduction for the current fair value, not what you bought it at. Similar. We're using a similar strategy like this.
Similar strategy where your cost basis could be $50,000, but the charity deduction coming to you is going to be a multiple of that because we're donating appreciating property that's evaluated, attorney backed, and audit defense included. It is a tremendous product. We put a lot of clients in it.
I've done it the last 2 years in a row.
You personally did it. I personally did it.
It's not always guaranteed to be a certain multiple, but it is
That's the
guaranteed
risk.
to appreciate
That's
it.
the risk in this deal is valuation risk is going to be your biggest risk. What if it comes back 4x? But the thought being, if you put $50K into this charity, you're going to save $80K in tax. $30K off the bat,
or more.
you're ahead.
Yeah.
Yeah.
So I do that.
I would.
I'd throw one last one in. If you're a high income earner, if you've married, you have a spouse that is working part-time. If you have some kind of other spouse where it's different and they have extra time or they have a passion to do something that could be turned into a business, there's tax benefits in that. There's a lot of tax benefits in that. There's different ways you can skin the cat. You want to align with what you and your spouse want to do, what's comfortable, what's in your values, in your future plans. But there are tax advantages. Suddenly you're getting active deductions because your spouse does shit. She goes and opens a car wash. Make sure you're following the rules. She gets that equipment, gets bonus depreciation. Boom. Suddenly that bonus depreciation on that equipment that's making your family money, and your spouse is out earning you now, that also eliminated your taxable income and you pay no tax.
Yeah.
I think that one would go on the top best.
Because we see this all the time in practice. If someone's a high earner, typically their spouses stay at home because they have children, or very rarely are both spouses making $1 million to bring $2 million to the table. Very rarely. It does happen, but more than likely we see, the entrepreneur, go-getter, doctor making money, and then you have a stay-at-home spouse about majority of the time. Getting with a tax planner and making sure, is there any way to utilize the stay-at-home spouse, to offset the liability of the high-income earner? Huge.
One example I'm going to share really quick, and this happened in the past year or so with one of our clients. New client comes in, both spouses working. One spouse is making over $1 million a year. The other spouse is at this job, been at it for a long time, making $70,000, $80,000 a year, but they hate their job. The high-income earner actually likes his job. The low-income earner hates their job, but they want to contribute. We talked with them and showed them, if you do X, Y, Z, would you be interested in this kind of job, other spouse? And the spouse was like, oh, I would love that, but I just don't know if I'm going to be good at it or not. Well, let's look at what kind of tax benefits you can get doing that. If you did that, and assuming, in this case, they actually did pretty good, but assuming they can't make much money or they make very little, instead of making $70,000 a year, they only make $10,000. The tax benefits they got saved the family, the married couple, a couple $100,000. So by doing something they wanted to do, even making a little less money at it, they ultimately were adding $200,000 to the net bottom line for that marital couple.
Yeah.
That's another awesome one.
Yeah, that is great. And look at your children too. If you're self-employed and you have children, you can always move money from your tax bracket to their tax bracket. And there's legit ways to do that. We teach our clients all that all the time. So that's another strategy we could implement, is a lot of high income earners are self-employed. So look at those too.
I would say the number one rule of thumb, if you're a high income earner and you are tired of paying taxes the way you are, first, change your facts so you can change your tax. I mean, Einstein's definition of insanity is continue doing the same thing over and over again and expect a different result. Stop being insane. Change it up. Do something. Change your tax facts. Look, go do some research. Read some books. There's some great books out there. Wheelwright has a great one. Go look up Tom Wheelwright's Tax-Free Wealth. There's another one too. Go look up his books. Or meet with a tax strategist, because you don't need to pay the tax that you're paying, most likely. Most likely you're paying more taxes than you should. Don't tip the government. Do something. Take action.
Yeah, that's good advice. If you do have a current CPA or tax planner and they're not giving you the level of service, attention, or diagnosis or detail you need, or strategies or options, Mike and I, we're always available for conversations. We offer free consultations. If you go to our website, revotaxpayer.com, you can go there and click schedule a consultation. Give us just a little bit of information. Hey, name, email, what you want to talk about, and let's just chat for 15 minutes, maybe 30 minutes. Let's just get to know each other, see if we're a good fit, and then we can see if we can add value to your life. Because like Mike said, you're probably overpaying tax if you're just using a preparer. So reach out to us.
Let's say you're listening to this, you just don't like Kevin, or you just don't like me.
Or both of us. What?
Or both of us. Go find a tax strategist. We're not the only ones out there. I think we're one of the better ones out there.
I do.
Or two of the better ones out there. But go find a tax strategist. Do something different. Own your fate, please.
Yeah. I don't think we're not the only ones out there, but the market, the little behind the scenes, CPAs are notorious for preparing taxes, sticking their head in the dirt, and just preparing taxes because they're so far behind preparing. Like our team is preparing 2024 tax returns.
Yes.
But we are also tax planning proactively and meeting with clients. I met with 2 clients yesterday on what we call discovery calls. Our current client base gets to hear from Mike and I on a proactive basis, and we try to see how we can save them taxes. How did the filing go? Is there anything we could do better? Did the plan go okay? We talk about it. What can we do for 25? What's going on? Any life events? Any big changes? Talk. It's communication, and find a CPA that'll talk is very hard.
Yeah.
They want to stick in their cave and crank out work.
You think your tax preparer CPA is a good tax strategist, but you don't talk to them throughout the year? Even if they are good strategists, they're not helping you because you got to change your facts in real time before the end of the year. So, with that said, find a tax strategist. Stop overpaying your taxes, please. Please like or subscribe our podcast so you can be kept up to date with all the new tax stuff out there, especially this year. In case you hadn't heard, there's a new big beautiful bill. It's either passed already when this airs or it's going to pass soon. Tax law is changing. Use it. Leverage those tax law changes. Don't be a victim to it. Hidden money.
Welcome to another episode. We're still standing. The Internal Revenue Service is still